Welcome to Market Sentiment, your ultimate channel for all things market, investments, and trading. In this special episode, we will discuss the real reasons why people lose money and how to make consistent profit. We're going to unveil the mysteries behind unsuccessful trades and lay out the strategies for lasting financial success. When you look into stock market investing, you'll often hear that 90% of investors lose money. This isn't merely anecdotal. It's rooted in fact. Even so, many people think they'll be in the lucky 10% that makes a profit. To be in that group, it's essential to know why most people lose money and avoid making those mistakes. Nobody starts investing planning to lose money. Still, there are many stories of losses, sometimes even more than success stories. But investing isn't a sure way to lose money. By avoiding few common mistakes, you can protect your investments. Two big feelings, fear and greed, play a huge role in investment decisions. It's hard not to be emotional, especially with money involved, but managing these emotions can save you from big losses. With that said, let's talk about 5 common mistakes made by new and experienced investors alike. Knowing these can help you invest smarter. Let's explore the main reasons why so many people end up losing money in stocks. Awareness of these will sharpen your investing acumen. First up on our list of what not to do is day trading, or even frequent trading. Day trading involves buying and selling stocks within a minuscule time frame, sometimes within hours, aiming for multiple small profits to compound into substantial gains. It's a relentless chase, hopping between stocks, seeking that opportune moment. Yet, this pursuit often culminates in loss. And a vast majority of day traders lack a track record of consistent success. Jumping between stocks to find the perfect moment to buy or sell usually results in losing money. That's why there are few, if any, day traders who have a long-term record of success. The idea of quickly buying and selling stocks for easy money is tempting, but it's tricky. Predicting how a stock will perform in the long run is challenging, let alone predicting its next move in minutes or seconds. It's hard enough to figure out what the stock will do 5 or 10 years down the road, let alone how it's going to react tomorrow, or 15 minutes from now, or 3 seconds from now. Yet day traders are shifting from one position to the next, hoping each trade wins. It's really hard to always pick the right times to buy or sell stocks. Even if you're watching closely for days or weeks, things can change suddenly. The top investors like Warren Buffett, Peter Lynch, and others keep their stocks for a long time and do not sell them often. It's a good idea to be patient like them instead of always trying to guess what a stock will do next. It doesn't mean they never sell. It's just that the times they do are few and far between. It's better to follow their approach instead of trying to predict every stock's next move. Speaking of swift, ill-advised decisions, the second item on our list, which often traps naive investors, involves trading penny stocks. Big-time investors usually stay away from penny stocks because they often lead disappointing outcomes. While sometimes you might find a penny stock that does well, most of the time, it's like guessing the flip of a coin and losing. Penny stocks are known for their extreme volatility. Their prices can skyrocket or plummet based on speculative trading and rumors, rather than solid financial fundamentals or intrinsic value. These low-prices stocks usually make big promises about becoming the next Amazon or Walmart, but it's mostly speculation. Many times, the people promoting these stocks just latch onto the latest trend, push the stock's price up, sell their shares, and leave you with stocks that are nearly worthless. It might feel exciting to own a lot of these shares for just a little money, and if the stock's price goes up even a tiny bit, it seems like a big win. But in reality, many of these stocks are just schemes to get you to buy more. Investing in penny stocks is more like gambling than investing, with even worse chances than casino games. Another treacherous path is investing using margin. Using borrowed money to invest, known as margin, can feel like a secret weapon when things are going well. It's a bit like using a credit card. Easy to use, but can lead to big troubles if not managed properly. By using margin, you're essentially taking out a loan based on your current investments and using that loan to buy more stocks. Sounds tempting, right? But here's the catch. Markets can be unpredictable. You might feel like a pro when everything's green and your stocks are up, but markets can and do turn, and when they drop, things can get rough if you've borrowed too much. Imagine one of your stocks, one that you borrowed heavily to invest in, takes a hit. Suddenly, you could be asked to add more money to your account or risk having parts of your portfolio sold off. Think of it this way. Owning a house with a mortgage can be smart, but using a second mortgage to fund a weekend in Vegas? Not so much. That's what investing on margin can be like. Therefore, it's always a good idea to focus on choosing solid stocks with good futures and holding on to them. This way, you can aim for good returns without the added risk and stress of borrowed money. With that said, the fourth reason a lot investors lose money because they want to make quick money. Most of the time ended up losing money. If you're looking to make money fast, the casino might be a better bet than the stock market. The stock market isn't a get-rich-quick game. Sure, there are stories of people striking it rich overnight, but they often have tales of big losses too. And it's safe to say no one wants a loss, especially when they're just starting their investment journey. It's fascinating how people who've patiently grown their money in fixed deposits at 5-7% a year suddenly expect to double their investments in mere months once they enter the stock market. Here's some perspective. If your investment doubles in 5 years in the stock market, that's a return of over 14% yearly. That's already way more than what fixed deposits offer. Rushing to double your money often leads to poor choices. This hurry often pushes people towards smaller, riskier stocks that swing a lot in price. Remember, patience and smart choices usually pay off more than chasing quick cash. The final pitfall in our list, that made investor lose money, is a lack of patience. Being patient is key in the stock market. There'll be times when the market is down for extended periods, and your investments may not show any growth. Worse, they might even be in the negative. Many newcomers to the market can panic in these situations. When they see their stocks dip by 20 or 30%, their immediate reaction might be to sell and cut their losses. But if you've chosen a good stock and the whole market is experiencing a downturn, staying patient is crucial. Remember that the bear market does not continue for very long. Just like the bull market does not last forever. There will always be ups and downs in the market. You must have patience when investing in direct equity. Have their natural cycles of highs and lows. When investing directly in stocks, it's essential to ride out the lows and remain patient. By avoiding the pitfalls we've discussed, you're on the path to becoming a successful investor. To new investors venturing into the stock market, it's essential to be mindful of certain practices that might hinder your investment journey. Investing wisely today will pave the way for a brighter financial future. If this video resonated with you, please engage with our content, please. Like, comment, and subscribe to Market Sentiment. Thank you for watching!